Welcome to the Neighborhood Law Center. I'm your host, Melvin Burris, and our topic today is, what do you need to know about mortgages when financing your home? And our expert here today is Jacob Schaup.
Melvin, thanks so much for having me on. I'm thrilled to be here.
Okay, thanks for being here. And
Absolutely.
before we get started, usually my audience says, well, Mel, why don't you ask the guest to give us a little about background?
Of course, I'd be happy to. So I'm actually born and raised right here in Charlottesville, Virginia, and I actually attended Charlottesville High School and UVA. And after I graduated UVA, I've been working in the mortgage industry ever since. So I graduated UVA in 13, and the rest is history.
The rest is history.
Absolutely.
And you enjoy it, I see.
I do. I love it. It's a roller coaster ride, and it's very exciting.
Okay, I'm going to ask you some questions then.
Perfect.
And maybe you can give us some answers to help our buyers or our audience who are interested in purchasing a home and
Absolutely.
getting a mortgage.
Absolutely.
What they need to know.
Absolutely.
First of all, how do they apply for a mortgage?
Sure, that's a fantastic question. So really, you have to reach out to your lender. So a lot of people will take a look at their personal finances and say, hey, you know what, I'm looking at my bank statement here, I think I can buy a home. But really, you're not going to know until you pick up the phone and make that phone call to that lender or fill out an online application and have a professional look over it.
What does and in that line, what factors does a lender like yourself
Exactly.
look for
That's right.
when going forward to doing a loan?
Sure, another great question. So there are three basic factors that all lenders and banks and brokers will look for when doing a mortgage loan. And it's actually summed up in a neat acronym, CCI, and that's cash, credit, and income. So cash is any assets that you might have. So these include things like your checking and savings account, any retirement accounts you might have, money markets, an IRA, a 401k, any cash on hand. I'll of course encourage you to deposit that in the bank. But it's pretty much any liquid assets that you have, anything that you could put towards the transaction. So the other aspect there is credit. So credit is very easily checked. You just need a few little tidbits of information, and you can pull a full credit report. And credit ranges anywhere from a 400 to all the way up to an 850. So in general, a lender will be looking at credit scores of about a 580 and above as viable. And really, if you want to get the best deal possible, you're going to want to shoot for a 680 to an 800 credit score. And you know, it might sound tough to obtain, but really, if you're timely with your bills and you pay your credit cards on time and you don't have an exorbitant amount of debt that you're not paying, it's not too difficult to obtain those levels of credit.
That's a good.
Exactly. Yeah, and the last factor there is income. So income is obviously how much you make each year from your employer, and the lender is going to be looking for steady income over that time.
Okay, that's almost the recipe for when am I ready to buy a home.
Exactly right.
When you're ready to buy a home,
That's right.
You're ready for a mortgage then. So
That's right.
So that ICE, what is that again? That
CCI, yeah.
CCI.
Cash credit income.
Cash credit income is a good barometer.
It is.
If in fact you want to buy a home.
It is. It is.
If you mentioned credit scores.
Exactly.
What if a person had a bankruptcy in the past?
Sure.
Does this mean that they can never qualify for a loan?
Absolutely not, and that's actually a really common misconception there, Mel, is that, you know, somebody will say, hey, you know, I declared bankruptcy back in '05. You know, I'm precluded from buying a home for the rest of my life, isn't that right? And I'll say, no, absolutely not. There are what we call seasoning time frames for the different loan programs out there. And essentially that's just a fancy word for the amount of time you have to wait after your bankruptcy. So the longest amount of time that you'd have to wait is 4 years, and the shortest is actually 1 year. There's a program through the FHA, the Federal Housing Administration, where you can get into a mortgage loan one single year out of a bankruptcy. Now mind you, this is a very niche and specific program, but it plays into my general point that a bankruptcy doesn't preclude you from your entire life for getting a mortgage loan, and I encourage you to give your lender a call and talk about it, even if you are out of a bankruptcy.
Okay. Now you mentioned lender being a banker or a broker.
That's right.
What is the difference between the two?
That's a fantastic question. So there's a basic difference between a banker and a broker, and I actually have the ability to do both, which puts me in a unique and I think a good position, to be honest with you. But here is a broker. A broker will originate the file, so they'll start it out, and then when it comes time to fund it, they'll send it off to a bank to fund it. They'll find a bank, they'll find a banker who can fund that. Now, a banker will originate the file, work through the transaction, and then fund with their company's money, so they'll keep it in-house the entire time.
Well, if you listen to a broker, he would say, well, use a broker rather than banker because I can look around
Sure.
at the different
Sure.
banks to find the best loan for you.
Sure.
How do you counter that?
Sure. Well, I think that there are advantages to both being a broker and to being a banker. So the main advantage I see with being a broker is that you can look around and find that, find that lowest possible price, or maybe find a more niche program, which is why I do actually broker a good number of my transactions. If I look around in the marketplace and say, hey, look, here's a great option for you guys. Now, that being said, the downside is that you're releasing that transaction to another party. So if you have a trust with your client that you yourself are going to close this loan and take them from start to finish, then at a certain point you have to cut them loose, and a lot of people are not comfortable with that. The fact that it has to be transferred over to somebody else.
Okay. Well, we're talking about financing a home. Right now, interest rates is what, 3.45 or 4?
Yeah, right in the mid-3s. They're really good.
So now it's not only a good time to purchase a home, it's also a great time for refinancing.
Absolutely.
What's the rule of thumb on that?
Absolutely. So with a refinance, the rule of thumb is that you want your savings per month to outweigh any closing costs that you might have on that. So if you're going to save, say, $200 per month and you have, say, $2,000 in closing costs, it's a no-brainer for me because after 10 months, you'll have recouped those closing costs, and from there, it's just butter on the toast. It's just extra money, extra savings each month.
Okay, so rather than looking at the interest rate, saying that the interest rate should be 1 point lower
Sure.
than what your current interest rate is, you're saying the dollar amount.
Exactly.
What about the interest rate? How much, which is easier, because if I'm paying
Sure.
5%, 3.5% is a no-brainer.
Absolutely.
Now, if I'm paying 4%, then is that worth me going through the loan process again?
Now, that's a fantastic question. And really what it comes
beforehand.
down to, Mel, is how long you plan on staying in the home. So if you're going to be in that home for the next 30 years and you're sure of this, you and your family are settled and you're not looking to move anytime soon, then I would say even a marginal monthly savings is in your best interest. Now, if you're thinking, oh, myself and my wife, we're going to move, after a few months here, I'd say absolutely not. Don't do it, and I'd put the brakes on that transaction. So you really want it to be worth worth your time and worth your money. And what that comes down to is how long you're going to stay in the home.
All right, well, we're talking about time again.
Absolutely.
So how long can a person expect
Sure.
to get the keys, the process? How long is the mortgage process before you have a closing and you're handed the keys?
Sure, absolutely. So for most programs, it's 30 days or fewer. So that's a pretty quick turnaround. Now the caveat to that is for a USDA loan, which is through the Department of Rural Development. We allow a little bit more time for that because their time frames are a little bit slower. They're a little bit more laid back. So that one would be about 45 days. But in general, it's about 1 month from contract to closing.
Okay, that's excellent. So once they close, do they keep that, do they lock in on that interest rate? Or
Absolutely.
if they wait another 6 months because somebody else needs to do something else, for instance, the seller needs to do something for the house, some repairs to the house, that takes them another 2 or 3 months. Is my loan locked in, or do I have to pay for that locked-in interest rate?
And that's actually a topic that we'd assess on a case-by-case basis depending on the client and the particular situation. So in general, yes, your loan will be locked. I'll lock you about 15 to 20 days outside of closing. And I have a ticker, that runs on the bottom of my computer, so I'm watching the market like a hawk. And as soon as I see that thing dip to as far down as it's going to go, I pull the trigger on it and lock it. So what that does, the advantage of that is that if there's a big market spike, you won't be affected. Your rate is locked in and steady. Now, you do have the option to play the market a little bit, as it were, and not lock until the very last minute, or leave it floating for a while. Now, the risk there, obviously, is that it could spike. And the potential advantage is that it could drop. But in most cases, locking in the rate is absolutely the way to go.
Okay.
Yes, sir.
Is there a cost? What are the costs that occurred
Sure.
on the closing of a home or
Absolutely.
preparation of a mortgage, I should say?
So the main costs are transfer fees to the government, taxes. You have an appraisal, which is a professional designation of value compared to other homes in the area. A lot of transactions will have an inspection to make sure the house isn't about to fall down. So yeah, there are a fair number of costs associated with obtaining the loan. Sometimes, if you're interested in what's called a rate buy down, which is where you pay slightly more at the closing table to knock that rate down even farther. Now, a silver lining of closing costs is that often you can wrap them in completely into the financed amount, so into the mortgage amount. And if you're interested in not coming out of pocket for anything at the closing table, for example, you can oftentimes wrap those costs right in there, and at the closing table you'll be coming out of pocket with, I had a client recently who came out of pocket with $15 at the closing table. So, absolutely. So if you're looking to keep your assets intact and to not just take all your money that you've been saving and put it down, wrapped in closing costs are often a way to do it.
And that's based on their cash flow, that in fact they can handle this increased mortgage rate.
Exactly.
Mortgage payment, I should say.
Exactly right.
Okay.
Yes, sir.
We talked about getting a loan, but what could delay a loan?
Sure.
As far as your clients are concerned, or as far as the mortgage company or banker is concerned?
Absolutely. So a few things that can postpone your ability to get a loan could be, say you're somebody who's self-employed. Well, you only just started this business 3 months ago. Unfortunately, you're going to have to wait another year and 9 months before most mortgage companies and most lenders and most banks are going to approve you for that. And that's for the simple fact that we just don't know, they just don't know whether the business is going to work out. So from a risk standpoint, it's a little bit too risky until you have a couple years of self-employed income under your belt. Other things that could potentially jeopardize a transaction are a bankruptcy will put you out a few years, having overdraws on your bank account. General fiscal irresponsibility is a big red flag. So, those are things that could delay it.
Okay.
Let me tell you one more before I move on. A big one actually is maybe not being entirely truthful with your lender or banker up front, because there was a time where you could get away with not verifying things and not being entirely truthful. It's tantamount to be totally upfront about anything going on related to your financing to your banker, to your broker, because they'll be able to then assess it with honesty and with essentially all your cards on the table and able to move forward without hiccups.
Okay, we're going to take a quick break here and let you know that this is Melvin Burris. I'm your host of the Neighborhood Law Center, and we're doing a program. What do you need to know about a mortgage to finance your home? And remember that you can also see the Neighborhood Law Center on the website, www.neighborhoodlawcenter.com. Our guest is from Waterstone Mortgage Company, Jacob
Shoup. Yep.
Shoup.
Jacob Shoup.
Okay, Jacob. Thanks for the help there.
Absolutely.
Okay, now
Absolutely.
as we continue, one thing my viewers ask me all the time is the fact that they hear about pre-qualification plus versus pre-approval.
Sure.
Now, those are two different types of
Sure. Absolutely.
of approving a loan or
Absolutely.
a position.
So the pre-qualification is a little bit more initial and is not quite as permanent as the pre-approval. So the pre-qualification is when before you've even started looking for a home, for example, you call your lender and say, hey, what am I pre-qualified for? About what can I go to? What's my maximum amount? Or, what's a good middle amount for me? Anything like that. So that's the pre-qualification. Then after you've been looking for the home with your real estate agent, you found a place that's great, You know, you've got the address and you've got the info on the property. You'll go ahead and send that to your lender, and they'll get you a pre-approval for that specific home. And what that allows you to do is enter into a real estate contract for that home and actually buy that home. Whereas a pre-qualification is more just kind of a barometer reading of where you're at financially and how much financing you can, you could get potentially. That pre-approval is much more set in stone and pertains to a specific resident.
So pre-approval is basically looking at your credit, looking at your income.
Exactly.
And things that pertain to you financially.
That's exactly right.
And the pre-approval is when you throw in the home.
Exactly
or
right.
the assets. So you say, okay, now that we know what type of home you're purchasing and the price of that home, now we can give you a pre-approval based on.
That's dead on, Mel. Absolutely. Okay. Quick study.
Okay. Okay. What documents do you need for, or a person need to apply for a mortgage?
Sure. So the basic ones are tax returns and W-2s.
How many years back?
We generally go 2 years back on tax returns. You need 2 months of bank statements, which is pretty easy to do. You can go into your Wells Fargo or your Bank of America, or even do it online in many cases. So you need your tax returns, your W-2s, and your 2 months bank statement, as well as just a few little items from our questionnaire, and that'll really allow the ball to get rolling on the transaction. Mm-hmm. Exactly.
Okay. One thing I want to do before we go further, Jacob, is let our audience know where they can contact you as far as your telephone number.
Sure.
And what is your website?
Absolutely. Yeah, I'd encourage you to reach out if you're interested in getting a pre-qualification or a pre-approval. You have a home in mind. You can contact me directly at my desk line at 434-529-8439. So 434-529-8439. Or even give me a call on my cell, 434-962-4850. I also encourage you to shoot me an email at jshoup, S-H-O-U-P, at waterstonemortgage.net with any questions you might have.
Okay. One question I have is, we talked about what do you need to purchase a home. One thing you need is a down payment, but how much of a down payment do you need?
You know what, that's a fantastic question, Mel, and actually it's as little as none. But if you are a conventional mortgage transaction, you'd be looking a lot of times at 20% down. So if you were, say, looking at a $200,000 home, you would want $40,000 for 20% down there.
Is there other type of down payments you can get? Is it conventional, FHA,
absolutely,
VA loans? What are those?
Absolutely. So the two 100% financing, so zero down payment options for you there, are USDA for a home in the county, and for VA if you're a veteran. Mm-hmm. Now, in my opinion, in my professional opinion, the best deal you can get on a mortgage is through the Department of Veterans Affairs. Mm-hmm. So, but obviously, normal civilians are excluded from that, as it's only veterans and active duty service members.
And the VA down payment is zero?
The VA down payment is as low as zero. If you want it to be zero, it can be. If you want to put money down on the home and have equity in the home, you're more than welcome to. Absolutely.
Now, in the old days, the FHA loans, you put a 3% down. Is that change, or is that still?
It's up to 3.5%.
Okay.
So it's 96.5% financing, which is still pretty good as far as not having a ton of money out of pocket at the closing table there.
Okay.
Absolutely.
So now we have the down payment.
Mm-hmm.
Now, how much money would be required at closing? That's another issue.
Sure. So a general rule of thumb is 3% of the purchase price. That gives you a good idea. So if you're buying a home for $100,000, then about $3,000 at closing is a good rule of thumb, Mel.
Okay.
Absolutely.
All right, let's go back and talk about the types of loans.
Sure.
The VA.
Sure.
Give me a little synopsis of the VA, the FHA,
sure,
and conventional, to let our viewers know
sure
what the difference or nuances are in all those.
Absolutely. So your basic loan, when most people think about a mortgage, is a conventional loan. And this is a loan that's backed by Fannie Mae and Freddie Mac. Mm-hmm. And these offer down payments anywhere from 5% all the way up to however much you want to put down on the loan. So there is a 5% Fannie Mae option there. 20% is quite typical. Now, these are loans for people who have established credit, who have established finances, and who have funds to put down on the home. And it's a great deal for people who are maybe a little bit more financially stable, you know, maybe have their ducks in a row a little bit better. Whereas an FHA loan is what I look at more as a bit of a Band-Aid program. So the qualification is not as stringent. They work down to lower credit scores. You do have to come up with some money out of pocket, but not a ton. It's really for people who, you know, a lot of first-time home buyers, people who've maybe had a little shot to their credit at one point but are now getting back on their feet. That's a good example of somebody who might fit into an FHA.
Okay.
Exactly.
And an FHA, okay.
Yes,
That's good. Now,
absolutely.
we talked about the VA. It's got to be a veteran or someone that's currently
That's right.
in the service on that. But what about a jumbo loan I hear so much about?
Sure, sure.
Some are conventional loans, I guess, and they're jumbo loans.
Sure. So a jumbo loan would generally be above that $450,000 mark and up. And we actually close those in-house. There's sometimes a tiny bit more difficult to obtain just due to the amount, but like I said, we've streamlined the process. And you know, if you are looking at an expensive property or one that might require a little bit more financing, I would definitely encourage you to reach out about that.
FHA has raised theirs to include the jumbo loans, haven't they?
That's right. Yeah, absolutely right.
Okay.
So the FHA is actually going through a few changes for the better right now, as I see it. One change that they've gone through very recently actually is they've lowered mortgage insurance. They lowered that just about in half. Actually, as of tomorrow, that will be in effect. So that's really breaking stuff right there. And I'm really encouraged by that because it means that, you know, the premiums won't be as high and that more people will be able to afford a home. It'll make payments more reasonable for people who are buying homes. And I think we'll see a general stimulation of the economy due to that.
Okay. And now we were talking about rates, and I was talking about the 3.6, whatever the rate is currently.
Absolutely.
But there's a fixed rate and adjustable rate.
That's right.
And there's other adjustable rates.
That's right.
How do you ascertain what is best for your customer? And can you tell us about the fixed versus the adjustable?
I'd be happy to. So what it comes down to is preference and goals for the particular client. So the only time that I'll really recommend and advise an adjustable rate is if the person is an experienced real estate investor, if they've bought homes in the past, if they watch the market, if they know what they're doing. I will never recommend a adjustable rate to somebody who's a novice, somebody who's a first-time home buyer, somebody who might get in over their head when that rate adjusts.
Okay, now tell us what adjustable rate is.
Sure, absolutely. So an adjustable rate mortgage, it will have a fixed rate for the first year, 2 years, 3 years, 5 years, depending on the term. And after that, it will adjust according to the marketplace. But in general, it adjusts up. It does not adjust down.
Yeah, right.
So, exactly. So you want to be sure that you have, so a lot of times who they're best for are people who are buying a home to sell it. They say, I'm going to have unloaded this home in 5 years, and I want to pay as little as possible on this home in the meantime. That's a fabulous opportunity to get somebody into an adjustable rate.
Okay, the fixed rate is?
The fixed rate remains, the interest remains fixed over that entire term of the loan. So if you choose a 20-year loan, then that'll be fixed over that 20 years. If you choose a 30-year loan, it will be fixed over those whole 360 months there. So you can rest assured, you can rest more easily with a fixed rate loan because it will never change on you. You'll never get a statement that says, hey, your rate's bumped up from a 3.5 to a 5%.
Right.
Exactly.
Okay, now, how does mortgage insurance plays into this? Some people are loaded down with mortgage insurance and say, which increases their...
So in certain loan programs, notably the FHA, mortgage insurance is taken out when the down payment is less than 20%. And what this is essentially assurance to the bank because they're seeing this transaction as taking on a higher risk. So, so if you're not putting a ton of money down, then mortgage insurance is going to be something that you'll deal with. Now, the good news is that it has been lowered recently down to a level that's much more manageable. And if you're getting into a VA loan, even if you're going with no down payment, it's non-existent. So, exactly right.
Now, we talked about what is better is, I guess, it's better a fixed or adjustable, and that's based on the individual.
Absolutely.
Okay.
Absolutely.
Do you see a scenario? You mentioned a scenario where if you're going to stay in that home for a minimum period of time, 5 years.
That's right.
Or 7 years or 10 years, you may look at an adjustable rate. But if you're going to stay there longer than that period,
That's right.
then you want to go to the fixed rate, unless, of course, you're trying to play the market and you see the interest rates are high
Exactly.
and you're saying they're going to fall back, so I'll get adjustable rate, which is the lowest rate at that time,
Exactly.
and then move into a fixed rate.
And then exactly what you do is then refinance into that fixed rate when you, when you and the professional who you're working with has designated that the time is appropriate to do that.
Okay.
Absolutely.
What would you advise for first-time home buyers?
First-time home buyers, I would say talk to your lender. It's the easiest way to clear up any confusions that you might have. Talk to a professional about it. Doing online research is okay, and it's a great place to start. But really what you want to do is have a sit-down face-to-face with somebody who is a professional in the field and can answer and clear up any ambiguities for you.
Okay, is there any particular thing that first home buyer needs to know versus an experienced home buyer who's had a home before?
Sure, and actually it's interesting that you asked that because the home buying experience, the process has changed a lot for people who even have bought a home in the past. So, a client possibly bought a home in '05 and says, hey, it was really easy to buy a home then. They didn't ask for any verifications. I didn't have to provide anything, and I got in this home. Why are you now asking me for my tax returns and my bank statements and all that kind of stuff? And the reason is that the landscape, the mortgage lending landscape has changed a lot. So not only for first-time home buyers, but for seasoned buyers as well. The fact is the market's a lot different right now, which really highlights the importance of talking to somebody who's up to date on it and is a professional in the marketplace.
So that's good. Now, that first-time home buyer is a good advice you're giving them.
Absolutely.
What about a senior, someone who is 65, retired,
Sure.
wants to still, he may be a first-time home buyer,
Sure.
he may be trading down.
Sure.
What advice would you give them?
Absolutely. Well, retirement income can be used as qualifying income for the home. So don't be afraid that, hey, I don't have my, I've retired from my job. I don't have my job anymore. I won't be able to retire. Also, something that some seniors are looking at is cash out on equity they may have in the home if they're looking to free up some equity, or even reverse mortgages. Now, I personally don't handle reverse mortgages, so I would refer that one out. But there are a few experts.
Okay.
Absolutely.
All right, well, we're running out of time. We've got a couple of minutes left. What I'd like to ask you is, what would you tell our viewers the most important thing about buying a home, financing a home,
Sure.
to keep in mind?
Sure. So the process can seem daunting, but it's important to keep in mind that there are people who will work for you really hard day in and day out in the transaction.
Okay.
Those people are your real estate agent and your lender, myself.
Okay, give my audience your pedigree again before we go, your name.
Sure,
telephone
absolutely.
number.
Just as a reminder, my name is Jacob Schaup. I work for Waterstone Mortgage right here in town. We're located on Woodbrook Drive up 29 North.
Website.
Sure, my website is waterstonemortgage.net, and my email is jshoup@waterstonemortgage.net. I encourage you to reach out with any questions you might have.
Okay, I'm Melvin Burris, and I'm the host of the Neighborhood Law Center. I want to thank you for coming in. You were very knowledgeable and
Thanks so much
expert
for
on the
having me.
subject. Okay, now I want to tell my audience, don't forget to if you missed the program, go to our website, neighborhoodlawcenter.com, and we'll see you again next week. Peace and God bless.
God bless. Thank you.
Yeah.